Hi, it's Jared Rogers again from Beyond Accountancy. This video is about topping up super for those of you who are interested in doing that before the end of the financial year. Before we start, a quick reminder that we are tax agents but not financial planners, so we can't tell you that you should add to super or that you shouldn't add to super. This should be seen as education or as an invitation to get tax advice, but not as advice to do anything to your super. So is topping up super a good idea? Well, we can't say yes or no for the reasons I just explained. But let me give you some facts to help you think it through and decide for yourself. So what is voluntary super used for? Well, mandatory super is just for retirement, but voluntary super has two possible purposes. One, retirement, or two, purchasing your first home, if that home is in Australia. Remember also, so to finish on that point, if you're not investing for retirement and you're not investing for a first home, then investing in super maybe doesn't make sense for you because neither of those two purposes matches what your financial goals are. When you add to super, your super fund will invest the money for you. So you need to ask, are you happy with where they'll invest it? And do you have enough surplus funds to invest? If you have $20,000, you thought I should invest this in super, but that's the last 20,000 you have and you like to have that as a buffer for financial emergencies, maybe the best thing to do is to do nothing. And finally, super is a compromise between saving on tax and locking money away. Even if you are investing for retirement or your first home, that might not be next month. It might be months or years or decades away. So you have to weigh up the tax savings, which is a positive, versus losing access to the money, which is a negative. So on the topic of tax, how much tax do you save by adding to super? Well, if you make a pre-tax deductible super contribution, then it will save you tax if you're in the tax brackets of $45,000 and above. If you're in the bottom two brackets, that type of contribution won't help you. There are other types of contributions which I'll talk about which will help you. The other thing to think about in deciding if you should top up super or not is that there are limits on super contributions. And if you go over the limits, there are tax consequences. So when you might want to rethink adding to super, here are a few scenarios. You're already over the limit just from what your employer is putting into super for you. You don't have a buffer or savings, for example, or as in you can't afford to invest. You don't want to invest money in the current market, or you're investing and saving, but not for one of the two uses of super being retirement or your first home. So hopefully that gives you an idea of whether you even want to add to super in the first place. In the rest of this video, I'll cover those contributions for low income earners that I talked about. I'll talk about what you might save in tax in a bit more depth and go through an example. I'll talk about the limits on super, including the carry forward limits, which is probably the aspect of this I get the most questions about. And finally, how do you claim a deduction if you do make a super contribution? The steps aren't as simple as you might think, and the process becomes really important. And today I'm talking about lump sum super contributions, the kind that people might make towards the end of June, because today is the 22nd of June. You can also add super regularly by making a salary sacrifice agreement with your employer, and you'll save just as much tax, so that how much you'll save section will be relevant to that. The process of actually making lump sums won't be so relevant if all you're considering is salary sacrifice and not a lump sum. So let's start with low income earners and their spouses. I'll explain why that's relevant in a second. So deductible pre-tax contributions don't help low income earners much. We talked about that. It's because the tax on super, 15% contributions tax, is actually worse than the bottom tax rate and pretty much the same as the second tax rate. But there are other types of contributions that can help. There's a low income individuals can save $500 through the government co-contribution scheme. And if you're a two-income family with one high and one low-income earner, the higher earning spouse can add to the super of the lower income spouse and save $540. If you do both those contributions, that's a total saving of $1,040. Here's a bit of a summary you might want to pause and look at. There are different limits for the two types of contributions. One involves a low-income earner making a contribution. They need to earn under $47,000. In the other scenario, the spouse of a low-income earner can add up to $3,000 and get an 18% tax rebate, but the income limit is $37,000 for the lower earner. For the co-contribution, you need to have been working. 10% of your income must be from work or running a business as a sole trader. There's no work requirement for the spouse contribution. And the spouse contribution requires you to do paperwork with the super fund, whereas the co-contribution, you just put the money in and the rest is automatic. So to give you a brief summary, the super co-contribution is where a low income earner adds $1,000 to their own super, and all they need to do is to lodge their tax return and the government will pay $500 to their super. The spouse contribution is where the higher income earner adds to the lower income earner's super. It's a maximum of $3,000. Some funds have paperwork you need to fill out for it to be classed as a spouse contribution. Others just give you a separate BPay code for spouse and personal contributions, and no paperwork is required. So check with the lower income earners super fund what their rules are. If a spouse contribution of the full amount is made, $3,000, the 18% rebate is $540. If less is added, the rebate is also less. And finally, when we're talking about income and income thresholds, this is adjusted taxable income. So you need to add your, well, not quite adjusted taxable income, it's assessable income with some adjustments. So you add assessable income, fringe benefits, and voluntary super contributions. This means that if you're only under the low income thresholds because your salary is sacrificing into super or into fringe benefits in the health sector or charity sector, then doing those things reduces your taxable income, but it disqualifies you from these contributions because the income test is different. All right, part 2, tax savings. If you earn over $45,000, adding to super means you pay less than half the rate of tax you normally pay. You're swapping your normal tax rate for a 15% tax rate in most cases. So in the tax bracket most people are in, 45 to 135,000, you normally pay 32. In super it's 15, so your saving is 17%. You notice that for one of those lines, the tax rate is 30. That's because high income earners, those earning over 250,000, pay what's called a Division 293 tax, which makes their total super 30%, but you are still saving tax. Even with the higher super, it's still better than personal tax. Here's a quick example of how that works. Say you earn $90,000 and you put $20,000 into super. That means you're saving 17% tax because you're in that 32% bracket. So the tax saving is 17% of the 20,000, that's 3,400, but happens in two parts. First, you pay $3,000 in super tax out of your super fund. And secondly, you get the 32% tax back, which is 6,400. So why is that important? The main reason that's important is because of the $20,000 that you're spending, if you're going to get 6,400 back, it only costs you 13,600 after tax to add that money to super. And the amount of money that's going to end up in your super is $20,000 minus the 15% tax. So essentially, you're only out of pocket $13,600 and you're transforming that amount into $17,000 available to invest in your super. Second example, a taxpayer has an income of $50,000 and makes a deductible super contribution of $20,000. This kind of works that contribution, 5,000 of the 20,000 will be in this bracket, saving 17%, but the remainder, the other 15,000, will be in this bracket here where the saving is very little, only 3%. So the lesson here is super contributions save tax if you reduce your income, but only down to 45,000. If you reduce it any further than that, you're probably wasting your time if what you're trying to do is invest in a tax effective way. You might decide to add more to super, but you're not going to save much tax. Super limits, this is the one I get the most questions about. So firstly, let's talk about first home buyers. First home buyers can release voluntary contributions to put towards the deposit for a first home. However, there are two limits, 15,000 per financial year and 50,000 over a lifetime. Anything you add above 15,000 will not be available until retirement. So if you add 20,000 to super as a first home buyer, you're saying, I want to invest 15,000 for my first home and 5,000 for my retirement. You're not saying I'm investing 20,000 for my first home. So for that reason, most first home buyers, although they could add more than 15,000 to super, they'll cap it at 15,000 per year. What about for everybody else? How much super can you add? Well, it's a pretty basic formula. You take the basic cap minus what's gone into super year to date. Now, note this point, that includes what you put in and what your boss has to put in, even though that's mandatory. So this year's cap is $30,000. How much has gone into your super fund? Well, you check your super fund to work that out. And then you add the carry forward cap, which is where you catch up on the unused limits from prior years, which I'll explain in more detail. So the year-to-date amount, the key thing here is the limit is based on the contributions actually received by your super fund. Now, super law is changing next month, and super will need to be paid into your super fund within 7 days of your payday. But the rules that still apply until the end of this month mean that your super fund, so your employer, can pay your super as infrequently as quarterly. So what does that mean? The super on your pay slip doesn't necessarily need to match the super that goes into your fund. When we're talking about super limits, it's the amount that's gone into your super fund. So the best place to check is your super fund if you're trying to work out how much of this year's 30,000 limit have you used. The ATO also records this under concessional contributions, but there can be a time delay between the super fund getting the money and then reporting it to the ATO. So your super fund is the most accurate way to work out your year-to-date amount. So the last part of our formula is a carry forward cap. So carry forward concessional contributions, this is where if you've got less than $500,000 in super as of the previous financial year, so for this year, 2025-26, we're looking at your balance on 30 June 2025. So we're going back in time. It means your super limit is effectively calculated over 6 years, and we call this carry forward concessional contributions. So there's a lot of words there, but let's put it simply. You added less than the cap in prior years, so you can add more than the cap in this year. So the 6 years over which we calculate the limit is the current year plus the previous 5. So that's our 6-year limit. At the end of every year, 1 year expires. You can never use it again. So for this year, when the 1st of July 2026 rolls around, you lose the opportunity to catch up for the 2021 year. That can never be caught up again. So how do you know how much you can carry forward? It's quite easy, this one. You go to MyGov, ATO, Super, Information, Carry Forward Concessional Contributions, and you'll see something like this. There'll be a green eligible or a red light not eligible, and I'll tell you how much is unused from the prior years. You'll be able to scroll down and see in detail where that amount comes from. So that 100 and something thousand is a combination of these 5 years. There's no special form or contribution type you need to use to use up a carry forward limit. You simply add super and you add more than this year's limit, which is 30 grand. So let's say you added in total between you and your employer $35,000 of super. That'll get split into, they'll apply the $30,000 to this year's limit, and the $5,000 that's over, that applies to the carry forward cap. And then the contributions are allocated to the oldest year to the newer. So firstly, whatever you put into super, it firstly goes to the 2026 limit. And then if there's still some left over, it goes to 2021. If there's still some left over, it goes to 2022, 3, 4, 5 in that order. So if you go over the cap, it'll firstly go to the 2021 year with the excess until it runs out over all the years. So what many of my clients like to do each year is that they'll add just enough super, not to use up their whole carry forward amount, but just to use up the rest of this year's amount, 2026, and the year that's about to expire. So for this year, that's 2021. So let's pick an example. These are pretend figures. This is not a real client, but say we had a client who had $26,000 left in their cap, and they had $25,000 in the 2021 cap. They couldn't just put 25,000 in and allocate it to 2021. They'd have to firstly use up this year's limit and add 25,000 on top of that, not just 25,000 alone. So in this scenario, they need to add $51,199.80 to add enough super to avoid that cap expiring. Now that's a lot of money. It's not often someone makes that large of a contribution. This could be somebody who's been in small business where super isn't compulsory, and they look at their super fund balance one morning, realize, oh gee, I don't really have much in this. I'm going to start topping up. Or it could be someone who's got lots of surplus cash flow suddenly and wants to invest it. Perhaps they've got an inheritance. Perhaps that person was new to Australia, and the reason they didn't add much to super early on is that they were here for study and now they're working. For whatever reason, you have a lot of flexibility in catching up. I mentioned you have to have super below $500,000. We're only worried about what your super balance was at the end of the last financial year at one point in time. It doesn't matter if you've since gone over 500,000 of super, but if you have gone over the 500 mark this year, and assuming your super is not going to go backwards, it could be now or never. That is, if you're under 500,000 at the end of 2025, but over at the end of 2026, if you don't catch up this year, you'll never be able to catch up again in future years because you'll be ineligible because of the $500,000 limit. So that's super limits. Hopefully that's helpful. It's a complex system. I wish I could explain it in a simpler way, but that's hopefully enough for you to help work out what's a good amount for you. So let's say you do decide to add to super and you want to claim a deduction. So firstly, if you're adding to super to get the spouse rebate or the co-contribution, do not claim a deduction because you can't do both. So if you make one of those contribution types, co-contribution or low income spouse contribution, you just put the money in and you don't claim a deduction. But let's say you're claiming a pre-tax deductible lump sum. What do you need to do? Step 1, pay the amount. Step 2, claim a deduction on your tax return. Oh, sorry. I meant to say, if you're claiming a deduction for anything else, say it's a membership or a subscription or a flight on a business trip, all you do is pay the amount, keep the receipt, of course, claim the deduction, you get the tax back. For super, there's an additional step. Pay the amount, pay the 15% super tax via your super fund, then you can claim it on your tax return and get the money back. So it's that extra step that's really important with super. So going back to how much tax will you save slide, you'll notice that the super, the $3,400 saving was firstly paying super tax and then getting back personal tax. So the ATO wants to be sure that you've paid your 15% tax before you get the 32 back. Has to be in that order. How do they prove that? Your super fund has to tell them you've paid it. So our top-up process, firstly you decide on the amount, which we've talked a lot about. You make the payment by the cut-off date. I'll explain that in a second. And then you pay the 15% tax by doing a notice of intent to claim a deduction form. So decide on the amount. We've covered that. Make the payment by the cut-off date. So just because the end of financial year is 30 June, doesn't mean you have till 30 June to make super contributions. It could be as early as the 23rd of June, as in tomorrow, depending on your fund. Some are more strict, some are more helpful. If you're planning a lump sum contribution, check the date with your particular fund before you make the contribution. It'll be a shame to put 10 grand into super, but not be able to claim any tax benefit until next financial year. And the last step is to pay the 15% tax by doing a notice of intent to claim a tax deduction form. So you need to complete the form and the fund needs to acknowledge the deduction, and then they'll tell the ATO. If you don't do this, you'll lose the tax break, and you've got to do it within a certain time. So what's the time limit for doing the paperwork, the notice of intent to claim a tax deduction form? It's the earlier of lodging your next tax return, so 2026, or changing super funds, withdrawing a partial lump sum from your super fund, converting your super fund to a pension fund, or the end of next financial year. So for most people, those last few points don't apply. So it's just a matter of making sure you do this paperwork before you do your 2026 tax return. If your fund allows an online form, use that. It's faster and there's less chance of them losing the paperwork, which I've seen happen, and it's cost clients thousands. So what's our summary from today? Low-income earners, consider a personal contribution or a spouse contribution. Middle and higher earners, compare the tax you'll save with the downside of locking money away. If you do decide to add to super this year, timing and paperwork are really important. The reason I'm releasing this today is because, as I said, it's the 22nd of June. It's almost your last chance. It'll be most likely for most funds this week. It'll be your last chance to add to super. For the less helpful funds, the cutoff might be even sooner. So thanks for watching. I hope that was helpful, and I'll see you in the next video. Bye for now.